Today we will talk about inventory valuation. For that we have to understand the meaning of inventory. So let us start with the concept of inventory. So inventories are defined under accounting standard AS2 as under: inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, in the form of materials or supplies to be consumed in the production process or in the rendering of services. So therefore there are three parts to the definition of the inventories. So one is held for sale in the ordinary course of business. That means in case of trading concerns, whatever assets are held for sale in the ordinary course of business, that is stock in trade, is treated as inventory. And in the second part of the definition is in the process of production for such sale. In the case of manufacturing companies, certain stocks are held for the purpose of conversion of those stocks into finished goods and then ultimate sale of those goods. So these are also treated as inventories. And the third part is in the form of materials or supplies to be consumed in the production process or in the rendering of services, or it can consist of consumable spares and stores which may go into the production process or which may be used while rendering services. So inventories consists of all these kinds of assets, and therefore the definition takes care of all the three situations. One is in the case of a trading concern, second is in the case of a manufacturing concern, third is in respect of consumable stores and spares which are used in the process of production or rendering of services. Normally the type of inventories is dependent on the nature of the business, what kind of industry the company is in or what kind of business the entity is carrying out. So inventories will depend on that kind of thing. The inventories of a non-trading concern consist primarily of products purchased for resale in the existing form. Normally in the case of trading concern, there is no change in the inventory. Whatever is purchased is sold. So that becomes the inventory. Whereas in the case of a manufacturing concern, whatever is purchased in the form of raw materials is converted into finished goods and then ultimately sold. So therefore in the case of manufacturing companies, there will be different kinds of inventory known as raw materials and components, then work in progress, also known as stocks in process, or also called semi-finished goods, and ultimately the finished goods. At the end of every year, an entity needs to value its closing stock, that whatever closing stock it has on hand needs to be valued, and this closing stock is always put on the credit side of the profit and loss account, also the trading and profit and loss account, depending on whether it is only a manufacturing concern or a trading concern, and thereafter it will go to the balance sheet also on the asset side of the balance sheet under the heading current assets. Therefore inventory valuation is very important, because inventory valuation will affect both the statement of profit and loss as well as the balance sheet. So for the following reasons, inventory valuation assumes greater importance. These are: one is the determination of income, second is the ascertainment of financial position, third is the liquidity analysis, and fourth is the statutory compliance. Statutory compliance means compliance on account of statute. In terms of certain laws, there is a statutory compliance requirement that the entities need to follow. So let us consider each one of them in detail. First of all, the determination of income. As we know, the valuation of inventory is necessary for determining the true income earned by a business entity during a particular period. So in order to determine the gross profit, cost of goods sold is netted with revenue of the accounting period. So gross profit is nothing but cost of goods sold, sales. The difference between these two is called the gross profit. And for that you need to understand the meaning of cost of goods. Cost of goods is computed as under. So it is given by the equation: cost of goods sold is opening stock plus purchases plus direct expenses minus closing stock. Actually here, if you for a moment forget about the direct expenses, what you are taking is the opening stock added to the purchases, and from that you are reducing the closing stock. So what does it mean? What it means is you are trying to find out the actual quantity of inventory which is used in the production process. That means whatever was there initially and whatever is added in terms of purchases, minus whatever is left out at the end of the thing. So, that will give you the consumption of materials during the accounting period. To that you have to add the direct expenses, and that will give you the cost of goods sold. So, therefore, since the closing stock and the opening stock go into the equation of the cost of goods sold, any valuation mistake can affect the cost of goods sold and eventually will affect the gross profit and ultimately the net profit. Therefore, overstatement or understatement of inventory will have an effect on the net income. Overstatement means closing stocks are stated at a value which is higher than the actual value. Understatement means closing stocks are always stated at a value lower than the actual value of the stocks on hand. So, what happens when the closing stock is overstated? As we have seen, it comes on the credit side of the profit and loss account or the trading and profit and loss account. So, whenever closing stock is higher, the total of the credit side will go up, and that gets adjusted in the net profit on the debit side. Therefore, whenever closing stock is overstated, net profit will go up or net income will go up, and the opposite will happen when the closing inventory is understated. That means the credit side of the profit and loss account will be lesser, and to that extent you have to adjust the debit side also, that will get reflected in the net income. So, whenever closing inventory is understated, which it means that the profit is understated or the net income is understated, and if it is understated in the first year, it will have effect in the next year also, because this year's closing stock will become the opening stock of the next year. So, it will have the opposite effect in the following year. Therefore, determination of income becomes important, and because of that valuation of inventory becomes very significant. Any mistake in the valuation of inventory will have a direct impact on the net income of the entity. Second point for the inventory valuation becoming very important is the ascertainment of financial position. As I have already stated earlier, in addition to appearing in the profit and loss account, the closing stock also finds a place in the financial position of the entity, that is in the balance sheet. So, closing stock always is part of the asset side of the balance sheet. It will be classified under the subheading current assets. Therefore, if the current assets are overstated, which happens if the closing stock is overstated, that will increase the asset side of the balance sheet, which will get reflected on the liability side of the balance sheet also in the form of overstating the capital or the net income of the entity. Therefore, any mistake in the valuation of inventory will affect the financial position of the entity. So, it will not be reflecting a true and fair position of the entity. Therefore, valuation of inventory is also important from the point of view of ascertainment of actual financial position of the entity. And the third importance for inventory valuation is the liquidity analysis. So, as we know, liquidity is a measure of the solvency of the company. That means the measure with which we can measure whether the entity is able to meet its immediate obligations within a period of normally 1 year, and this is possible if the current liabilities of the entity are greater than the current assets of the entity. That means the difference between the two is a measure of the liquidity, and normally liquidity is measured by a ratio known as the current ratio, which is the ratio of current assets to current liabilities. So, if the inventory valuation is not done properly, then that will lead to either overstatement or understatement of the current assets, which will result in giving a different liquidity ratio, and that will affect the liquidity position of the company. Therefore, inventory valuation has to be important from the point of view of liquidity of the entity also. Then lastly, statutory compliance is another important characteristic for the inventory valuation. So, particularly in the case of companies, there is a Schedule 6 of the Indian Companies Act 1956. It requires that the details of quantities of each class of goods along with the method of valuation of raw materials, work in process and finished goods should be disclosed in the financial statements. What it says is, we have to disclose not only the quantities of each class of goods classified into raw materials, semi-finished goods and finished goods, but also the valuation method adopted for valuing the inventory, that also has to be mentioned. The basic objective being that there should be proper disclosure of the valuation of inventory to the users of the financial statement, so that they are able to make informed judgment about the financial position of the entity. And secondly, as per the accounting standards also, the financial statement should disclose the accounting policies adopted for valuation of inventories, including the cost formula used, and secondly the total carrying amount of inventories and its classification. So, according to the accounting standard also, the entity needs to disclose the method adopted for valuing inventories, as also the total amount of closing stock, that is inventory held, and its classification into raw materials, goods in process and finished goods, that is compulsory. Therefore, even from the point of view of statutory compliance, an entity is required to undertake valuation of the inventory in a proper manner. And now let us try to understand what is the basis for inventory valuation. So, inventory should be generally valued at the lower of cost or net realizable value. This is the formula generally adopted. So, it has to be either at the lower of the cost or the net realizable value, whichever is lower. That means, if the cost is lower, then the cost only should be taken for valuing the inventory, but if the net realizable value is lower than the cost, then that should be taken. This is in order to give a measure of caution for the valuation of inventory. If the net realizable value is greater than the cost, then such net realizable value is ignored. And for that we have to understand the meaning of cost of inventory. What does it include? Cost of inventory is defined as the expenditure incurred in acquisition of goods. That means the cost incurred in bringing the goods to their present location and condition. So, all costs incurred to bring the goods to their present location and present condition need to be included. What is the meaning of present location and condition? For example, if raw materials are purchased from a supplier, whatever cost is incurred in bringing the goods from the supplier's place to the factory of the entity, or to the godown of the entity, or to the shop of the entity, has to be included as the cost, because that is the cost incurred to bring the goods to their present location. And the other part is bringing the goods to the present condition. For example, if the raw materials are converted into finished goods, so whatever cost is incurred in the conversion of raw materials into finished goods is the cost required to bring the goods to their present condition. That means the condition of the goods has been transferred from that of raw materials to that of finished goods. So, all these costs need to be included to arrive at the cost of inventory. Normally, cost of inventory therefore includes all the costs incurred in bringing the goods to the present location, that is all transportation costs plus all manufacturing costs for conversion of the raw materials into finished and semi-finished goods. And net realizable value is defined as the estimated selling price in the ordinary course of business less the estimated costs of completion and the estimated cost necessary to make the sale. That is called the net realizable value. How much money can be realized by selling the goods in the ordinary course of business. It is not distress sale, but in the ordinary course of business. Whatever is the value, if the sales price goes down, then obviously net realizable value will go down. That is the selling price at which the goods can be sold in the ordinary course of business. Therefore, at the end of each accounting period, the entity has to make an assessment of the net realizable value and thereafter compare it with the actual cost of the inventory and take whichever is lower. Inventories are usually written down to net realizable value on an item by item basis. So, what is the meaning of this? They have to be written down to net realizable value. If the cost is more than the net realizable value, then they have to be reduced to the net realizable value. This cannot be done on a gross basis. That is the meaning of on an item by item basis. So, in some cases the net realizable value may be lower, in some cases it may not be lower than the cost. So, each one we have to take individually, and then the difference between the cost and the net realizable value, wherever net realizable value is lower than the cost, has to be taken into account, and then to that extent the value of the inventory has to be written down, that means reduced to that extent. And only in certain cases it is appropriate to group similar or related items. If there are a number of items which are related to each other, then all these items can be grouped, and then we can take the value of all this group of items together and then try to compare the historical cost with the net realizable value. Now we will have to find out what are the different methods or techniques available for valuation of inventory. So therefore there could be different methods. For some inventory which are ordinarily not interchangeable, specific identification method is used. That means each item of inventory is specifically identified. There we have to find out what is the cost of the inventory and then the net realizable value and take the lower of the two. That is called the specific identification method. And in case of inventory which are ordinarily interchangeable, that means which can be interchangeable, usually historical methods are used. In some cases non-historical cost methods such as standard costing, adjusted selling price may also be used. So we have to find out what is the meaning of historical cost methods and how many methods are there and what are the advantages and disadvantages of each of these methods adopted for valuation of inventory. So let us try to find out what are the different historical cost methods. So historical cost method means cost includes cost of purchase and other costs incurred in bringing the inventories up to their present location and condition. This has already been explained. That means all costs which are necessary to bring the inventory to their present location as well as present condition have to be incorporated in the total cost. So what does it mean? It includes costs of purchase, that is includes duties and taxes, freight inwards and other expenses directly attributable to the acquisition of the goods. Therefore trade discount, rebates, duty drawbacks and other similar items are deducted in determining the cost of purchase. If there is a trade discount offered on the purchase of goods, that has to be deducted. If a tax has to be paid on the goods, that has to be added. If the freight has to be incurred inwards in bringing the goods from the supplier's place to the place of the entity, then those expenses also have to be added. So these are called the costs of purchase, and other costs are included in the cost of inventories only to the extent they are incurred in bringing the inventories to their present location and condition. So in determining the cost of inventory, certain costs are excluded and recognized as expenses in the period in which they are incurred. So examples of such excluded costs, that means those costs which cannot be included in the cost of inventories, are costs arising due to abnormal amount of wasted materials, labor and other production costs. If there is an abnormal wastage of materials, then that cost cannot be included in the cost of inventories, that is stated separately. Similarly, storage costs, unless these costs are necessary in the production process prior to further production stage, are excluded. Suppose finished goods are stored before they are sold, such storage costs cannot be included. But if raw materials have to be stored until they are ready for process to be processed into finished goods, then such storage costs can be included. So certain storage costs are excluded, certain storage costs are included. And similarly, administrative overheads that do not contribute to bring the inventory to the present location and condition are also excluded. That means anything which does not directly relate to the inventories are excluded. Similarly, selling and distribution costs are also excluded. So all these are examples of excluded costs in arriving at the cost of inventories held. So now we will find out what are the different methods available for valuation of inventories under the historical cost methods. So under this, there are different names given to each of the methods. They are, one is called the specific identification method, second is first in first out method, also normally called FIFO method, and the last in first out method, also called the LIFO method, that is LIFO, and the average price method, and also the weighted average price method. So let us discuss each of them. As we know, we have already discussed about the specific identification method, where each item of inventory is specifically identified and the actual cost incurred in acquiring that particular inventory or object is taken into account. That is called the specific identification method, which is not normally used in general cases. Only where the goods bought are not interchangeable at all, in such cases that specific identification method is used. So, the common methods for goods which are ordinarily interchangeable are the remaining 4 methods. So, let us start with the first method among them, called the FIFO method, also known as the first in first out method. So, as the name suggests, goods received first are issued first, that means are supposed to be used in the production or in sale. And secondly, the goods on hand, that is the stocks on hand, therefore consist of latest consignments. That means whatever has come into the factory later is said to be part of the stock of goods on hand. So the closing stock is always valued at the price paid for such consignments. That means the value of the closing stock will be dependent upon the price paid for the latest consignments, because all the earliest consignments are presumed to have been used for either for production or for sale. And in the case of last in first out method, it is exactly the opposite. There goods received later are issued first for production or sale, that is the assumption. That means whatever goods have come later are treated to have been used either for production or for sale. So, whatever is left, that is the stocks of goods on hand, consist of earliest consignment. So, the inventory valuation will be dependent upon the value paid for such earliest consignments. That means if the price paid is lower for the earliest consignment, and that price has to be taken. Whatever is the price paid for the earliest consignment is taken in the case of LIFO method. In the case of average price method and the weighted average price method, we work out the average of the prices of the inventory items bought at different points of time. In the case of a simple average price method, we only take the average of all the prices. Suppose goods have been bought at 5 different prices during the course of the year. In that case, all the 5 prices are added and divided by 5 to give you the average price. And in the case of weighted average price method, weightage is given on the basis of quantity purchased. If, for example, let us say 100 tons are purchased at 20 rupees and 50 tons are purchased at 18 rupees. So, if you have stocks on hand, then the valuation has to be done based on the weightage. So, the weightage for the first purchase will be obviously more, because 100 tons have been purchased, and for the second weightage will be less. So, weightages could be 2 and 1, because in the first case we bought 100 tons of goods, in the second case we bought 50 tons of goods. So, weighted price is calculated by multiplying the weight with the price of that particular quantity, and all are added, and the entire thing is divided by the total of all the weights. Therefore, weighted price gives a better average of the price. Therefore, normally whenever average price methods are adopted, they are usually the weighted average price methods. And in the case of non-historical cost methods, there could be methods called adjusted selling price method, or the standard cost, or the latest purchase price method. So, all these can be adopted when non-historical cost methods are adopted, but normally most of the entities follow the historical cost methods, and that too the 4 methods which we have discussed now. So, now coming back to the inventory record system, how the inventory is to be maintained. So, normally either inventory is maintained or periodically, or it can be maintained on a continuous basis. So, these systems are known as periodic inventory system or a perpetual inventory system. So, in the case of periodic inventory system, as the name suggests, the value of stocks is ascertained by physically counting the stock at the end of the year. So, at the end of the accounting period, we have to take inventory of all the items present, and then they are valued by one of the methods which we have discussed. In case of very large stocks, what happens is normally this kind of physical verification of stocks may take a number of weeks, a few weeks, and this may affect the normal working. Therefore, normally this is avoided. It may not be possible to take inventory on the last working day. Therefore, it gets extended into the next accounting period. So, if it is done over a period of time, then we need to make adjustments for receipts and deliveries occurring after the close of the accounting period and up to the date when the actual physical stock is taken. So, in the case of perpetual inventory system, as the name suggests, we have a system which is on a continuous basis. For that purpose, stock registers are maintained for every item of inventory. So, whenever there is a receipt of inventory, it is recorded in the books. Similarly, when the inventory is issued, they are also recorded. So, all receipts and deliveries are recorded in the books, what we call the stock registers, as and when they actually occur. Therefore, at any point of time, it is possible to know the actual value of stocks on hand. So, this is the most scientific method, but only thing is it involves lot of work. So, in cases of entities which may have a number of inventories, a number of items to be stored, this may not be practicable. So, therefore, by and large, most of the entities follow the periodic inventory system, and in some cases where the value of inventories is quite high, it is possible to maintain perpetual inventory system because it is more scientific in nature. Now, let us try to understand the implications of using different methods under inflationary conditions or under deflationary conditions. Inflationary conditions means a rising market, that means the prices of goods are going up, and deflationary conditions means the prices of goods are going down. So, let us try to understand what happens under inflationary conditions when FIFO method is used and when LIFO method is used. So, as you can see from the chart, in the case of a rising market, that is under inflationary condition, if FIFO method is used, what happens is we are valuing the stocks in respect of the latest consignments. That means because of inflation, the latest consignments are always bought at a higher price. Therefore, the value of the closing stock will be higher. This is shown by an arrow pointing upwards on the board. So, whenever closing stock is higher, to that extent the credit side of the trading and profit and loss account will be more, and therefore it will get reflected in the net income. So, whenever closing stocks are higher, net profit also will go up. So, in case of a rising market, whenever FIFO method is used, it will result in increased, that is overstatement of the closing stock and simultaneously overstatement of the net profit. And in the case of a LIFO method, in a rising market, exactly the opposite will happen, because in the case of LIFO method, we are using the price of the earliest consignments. The earliest consignments in a rising market will always be at a lower value than the latest consignment. So, the closing stock valuation will be lower than what it should normally be, and because closing stock is lower, net profit also will be lower. So, in the case of a LIFO method, the exact opposite will happen. That means there will be understatement of closing stock and simultaneously understatement of the net profit. Now, let us consider what happens in the case of a falling market. That means when the prices are going down. So, let us take the FIFO method. So, as I said, FIFO method always takes into account the prices of the latest consignments. In the case of a falling market, the latest consignment will be priced lower than the earliest consignments. Hence, the closing stock will be valued at a lower level, and because of that there is understatement of the closing stock, and as a result of that even the net profit will be understated. So, it will be exactly opposite of what happens under FIFO method in a rising market. And when we go to the LIFO method, here the LIFO method takes into account only the last in first out. That means whatever is latest consignment is supposed to have been consumed. So, the prices are taken on the basis of the earliest consignments. In a falling market, earliest consignments are always priced at a higher level than the latest consignment. Therefore, the closing stock will be overstated to that extent. There will be higher valuation of the closing stock, and because of that the net profit also will be higher. So, this is the effect of using different methods, and this argument can be extended to the following year. What happens if the closing stock in 1 year is overstated? What happens in the next year? Because the closing stock of this year becomes the opening stock of the next year, the opposite will happen in the following year. If closing stock is overstated during the current year, then the opening stock will get overstated in the following year, which means the net profit will be understated. So, under a FIFO method rising market, the net profit in the current year will be overstated, whereas net profit in the following year will be understated. The inverse will happen if it is a LIFO method, And similarly, we can draw conclusions in the case of a falling market when FIFO and LIFO methods are used. The effect in the following year will be exactly opposite of the effect in the current year. Now, let us try to understand what is the requirement of Schedule 6 of the Companies Act 1956. This is a statutory requirement. Therefore, all entities need to compulsorily, mandatorily follow the requirement. So, in terms of this Schedule 6, inventories have to be shown under the heading current assets, that is part of the asset side under the subheading current assets, and have to be classified as under. So, first of all, we have to show separately stores and spare parts, then loose tools have to be shown separately, stock in trade has to be shown separately, and work in progress also has to be shown separately. And in respect of each item, we have to show the mode of valuation or the method of valuation is used. What method you are following for loose tools, what method you are following for stock in trade, and what method you are following for the work in progress. And in the case of P&L account, physical quantities of items of raw materials consumed and the opening and closing stocks of produced in case of manufacturing companies need to be disclosed. That means, we not only have to show the valuation, but also we have to show the quantities of raw materials consumed, and also the opening stock of finished goods as well as the closing stock of finished goods in terms of quantities. And in the case of trading companies, we have to show the purchases made and the opening is closing stocks in terms of quantities, and we should also give the breakup of each class of goods traded in by the company. That means, if the entity is trading in a number of goods, each of them has to be shown separately. So, this is the requirement of Schedule 6 of the Companies Act. With this, we come to the end of today's chapter, that is inventory valuation.